Thank you for making it out today. Today we're going to have a great class. We're going to talk about deductions from AGI. And I'm happy that you made it here today. And I'm happy that you're pursuing your degree, because there's plans for you to do big things. There's magic in thinking big. So don't limit yourself. You guys have a great deal of potential. And even if you're knocked down, guess what? We don't need to be knocked out. All right? Even though we could be knocked down, it doesn't mean that we need to be knocked out. So if we get knocked down, we're going to get back up. Those people that are successful have failed many times, but they kept on trying. So we could do it. Yes, we can. All right. So today we're going to talk about deductions from AGI, and we're going to try and get to some property transactions and some corporate taxable income examples. So I'm going to take you through a scenario. So take good notes on what I'm sharing with you. So I'm going to take you through a number of scenarios that are interrelated. But each one of these scenarios has to do with the same client, just different aspects of their life and the implications for their tax return. So each scenario, it's important that we make a note that each scenario is interrelated. All right, so this is the first scenario. Our clients are married. They've been married since Y2K. What year is that? 2000. 2000. Their adjusted gross income is $120,000. Their AGI is $120,000. They have 4 qualifying dependents, and we know to qualify for dependency, there's a number of tests. There's a number of tests for qualifying child and qualifying relative. Let's see if that's particularly relevant to this scenario at this point in their return. Their filing status is married filing jointly. Remember, we said that we have to decide what our filing status is, whether it's single or married filing separately, or married filing jointly, or widower, or head of household. In this case, their filing status is married filing jointly. They had some expenses. They paid $5,000 for a health insurance policy. So when we say they paid $5,000, that means that they paid $5,000 in insurance premiums to get a policy that provides health care. So whether it's called a health care policy or a medical policy, the significance in terms of the Internal Revenue Code and in terms of whether or not we could deduct that expense has to do with whether or not the policy provides health care. Does the policy pay for diagnostic testing? Does it pay for medical treatment? Does it pay for hospitalization? Because there's a lot of different insurance policies that we could buy. But in terms of what's deductible on Schedule A, the key is in terms of insurance premiums, it has to be an insurance policy that provides for medical care, the reimbursement of medical care expenses. Questions about that? Come on, Percy. Questions about that? So remember, there's a lot of different insurance policies we could get. For medical and dental expenses on Schedule A, it has to be an insurance policy that provides reimbursement for medical care expenses. In 2014, they paid the doctor, the dentist, and hospital bills totaling $9,200. $9,200, and they bought medicine that they paid $3,000 for. The insurance company reimbursed them $4,400. And in 2015, they expect that they're going to be reimbursed another $2,000. So what we need to do is decide first what expenses are qualifying medical expenses, and also then we're going to decide how much they can deduct on Schedule A. So they had some physician and dental and hospital expenses that they paid. How much was that? Now remember, we said that they could only deduct expenses that they paid. That you can't deduct expenses, even though you have an invoice. It's not enough to have an invoice, you have to have proof that you paid that invoice. So if it was paid by your insurance company, that's not something you could deduct. So here, we said that they were reimbursed by the insurance company for how much?
And then 6.
So how much is unreimbursed? How much is unreimbursed out of that? So if this is what they were reimbursed for, and that's what they paid, so how much is?
4,800.
$4,800. That's why I always say you are the best students ever. Ever. 4,800, right, Genesis?
Yes.
All right. Now they paid health insurance premiums. So what do you think about that? Is that something that they could deduct?
Yes.
Yes, in this case, they bought insurance, and I'm sure they have insurance on their home, and I'm sure they have insurance on their car. This is insurance that they bought to provide health care coverage. The company's going to reimburse them for those medical and hospitalization expenses. It's going to reimburse them for payments that they make to provide health care for them and their dependents. $5,000, right?
Yes.
How much did they pay for medication?
$3,000.
$3,000.
That's good.
Medication is expensive, right? So what is the total medical expenses that they paid? Did I hear somebody say $12,800?
Yeah.
So that's what they paid. That's the total amount of medical expenses that they ended up paying for after being reimbursed by the insurance company. So their total medical expenses were $17,600. Is that right? $17,600. And the insurance company reimbursed them $4,800. And these expenses specifically we identified as being qualifying medical expenses. If I told you that they also spent $10,000 for cosmetic surgery, then
That's not a fine expense.
that's not a qualifying medical expense.
But
Sure.
But if it was specified, would it be?
No?
Like, no?
Yeah, so everybody wants to have a full head of hair, right? So that's something that's not required. That's not a medically necessary treatment. So when we talk about cosmetic expenses, so those are things that are not medically necessary. So maybe you want your nose to be a little bit smaller, maybe you want your nose to be a little bit bigger. All those things, those are not medically necessary. So that's not something that meets the Internal Revenue Code's definition of a qualifying medical expense. All right, so these are their qualifying medical expenses after reimbursement. So now what we need to do is decide, well, are they going to be able to take this $12,800 as a deduction on Schedule A? So how much are they going to be able to take? Or are they going to be able to take anything? So what do we need to do? What do we need to determine first?
They're expecting 2,000 reimbursement from the insurance in 2015.
So I hear people saying AGI. So I told you that their AGI is $120,000. Why is that significant?
Medical expense, a percentage of the AGI.
So there's a floor in terms of how much we could deduct. So the Internal Revenue Code says in 2014 that the first 10% of AGI we're responsible for. In 2013 it was 7.5%. But in 2014 it's 10%. So 10% of AGI, which in this case is, so 10%, we said AGI is 120,000, 10% of that is 12,000. That leaves us with a deduction of $800, because the Internal Revenue Code says that the first 10% we're responsible for. That's the floor. So we're going to continue with this scenario in a bit more detail. What we're going to do now, so we figured out the amount of the deduction. So look at line 1 on Schedule A. See that section that says medical and dental expenses? Yes. So line 1 says medical and dental expenses. Now remember, line 1 is asking for the medical and dental expenses that we paid that weren't reimbursed by insurance. So what did we determine that was? We said, well, they paid $9,200, but then they got back $4,400. So actually, their out-of-pocket was $4,800. What about, didn't I tell you that in 2015 that they were anticipating getting another $2,000 reimbursed? Should we add that in here?
No.
No, because that's not in 2014. We're preparing the return for 2014. But let's wait and see what happens in 2015. They paid premiums for health insurance, that's $5,000, and medication is $3,000. That's $12,800. We could have just added it all up and got $17,000. Let's see. Is that right?
Yeah.
17,600 minus the reimbursement Why are we getting a different number there?
How does 17,000
Where's the 17?
Oh, okay, I see, okay.
12,008 plus.
Yeah, so what we could have done actually was, we could have taken the 9,200, $17,200 minus the 4,400, and that gives us 12,800. So these are just a list of the expenses that they paid. 9,200, 5,000, 3,000. They have canceled checks for all of those payments. That came out to be 17,200. This is how much they were reimbursed by the insurance company. So all we did was went through, totaled up all their medical expenses, all their qualifying medical expenses that they paid. That came up to 17,200. We subtracted the 4,400 they got from the insurance company. 12,800 is what they're out of pocket. That's what they paid. Those are qualifying medical expenses. But the Internal Revenue Code says that they could only deduct the amount that's more than 10% of the AGI. So that's why we computed this. So 10% of their AGI, 10% of $120,000 is $12,000. So that's the amount of their deduction. So on line 1, we put $12,800. That's the amount of medical and dental expenses that they paid that weren't reimbursed by insurance. On line 2, we put $120,000. Line 38 on the 1040 is AGI, the adjusted gross income. And I told you that their AGI is $120,000. So we put that in line 2. Line 3 says take 10% of $120,000 of that line 2. That's $12,000. We put that in line 3, $12,000. In 2013, that would have been 7.5%. That would have only been $9,000. The floor would have been $9,000. But in 2014, it's 10% of AGI. So line 4 is going to be 12,800 minus 12,000. That's $800. So on line 4, we put $800. Questions?
For the first one, you said medical and dental expenses is 12,800, but that's after the reimbursement, no?
Right, after the reimbursement. So we're going to put on, so Genesis is saying we're putting 12,800. Yes, that's the amount after the reimbursement. That's what we actually paid. So remember, we can't put down, we can't deduct amounts paid by others. We can't deduct the amount already paid by the insurance company. So we can't put the full 17,200 because 4,400 was paid by the insurance company.
Okay.
So we can only put 12,800 medical and dental expenses that we paid, and that doesn't include amounts reimbursed by the insurance company.
Okay.
Let's keep going. Taxes you paid. So our clients, you ready? Our clients had $7,000 withheld in 2014 for state and local taxes. $7,000 withheld for state and local taxes, and $15,750 withheld in 2014 for federal income taxes. $7,000 for state and local, and $15,750 withheld in 2014 for federal income tax. They also paid estimated tax. Every quarter, they paid state estimated tax, state income tax of $500. So in 2014, our clients paid estimated income tax, estimated state income tax of $500 per quarter. On April 1st, they expect to make a payment, or actually it turns out that they did. They made the payment. They made the payment on March 1st, 2015. They paid state and local taxes of $2,500. Their AGI is how much? $120,000. How much, in terms of taxes paid, you see the next section on Schedule A? How much are they going to be able to deduct? So on Schedule A, we're talking about taxes you paid. Line 5, income taxes. We're talking about income taxes. What is the amount of state and local income tax that they paid? Okay, so
7,000 plus the estimated.
the question is, how much are they going to be able to deduct on Schedule A for the taxes they paid? So who's going to walk us through that? Go ahead, tell us. Somebody, anybody. So $7,000 was withheld for state and local taxes. $15,750 was withheld for federal income tax. They paid $500 a quarter in 2014 for estimated state income tax. And on March 1st of this year, they paid state and local taxes of $2,500. How much of the taxes they paid are they going to be able to deduct on Schedule A? So let's see, what do we have?
11,000.
We have
Is it still 10%?
7,000 was withheld.
$1,500 as estimated.
Federal was 15,750. Estimated was 500 a quarter. So that's what else did they pay? Well, we know that in March
Payment of 2,500.
they paid 2,500. All right, we're going to evaluate these. We're going to talk about that. All right, so the question is, on Schedule A, what are they going to be able to deduct as taxes paid? Because we know that, yes, you can deduct taxes you paid. Which one of these? Let's see. Are they going to be able to deduct? Oh, are they going to be able to deduct the 7,000?
Yes.
7,000, okay, 7,000. Why?
That's the tax that come out their check.
They say on local tax.
So, it's an amount that they paid
So you have to check A.
to the state and local government that's taken out of their check. That's the withholding. So they paid that, $7,000. And it shows up on their W-2. So there's no question about that. So it's verifiable. It's very easy for the IRS to verify that. So you wouldn't want to put like 17,000 instead, right? Now what about this? Look at this number. 15,750 was withheld from their check for federal income tax. What should we? How much? We're going to take that too?
Yes.
No? So
No.
On Schedule A, you could only deduct the state and local tax paid, not the federal taxes paid.
These were going in the line 64, the tempo.
Now, what about they paid $500 per quarter? That's $2,000 a year, specifically for state and local income tax.
Yeah, so 50,
But
50.
one,
And then what about the $2,500 that they paid a couple of days ago in 2015? No, right? Because
so it's 2015.
no, 2015.
Only 9,000.
So it's 9,000, right?
Yes.
So somebody said, what about the 10%? The 10% rule doesn't apply to taxes you paid. The 10% rule, the floor, that 10% floor of AGI, that doesn't apply to taxes you paid. I'm positive. I know, I see that look on some of your faces. Are you sure? Yes, I'm sure. So 10% in 2014, you take 10% of the AGI, that's the floor as it relates to medical and dental expenses, right, Max? But for taxes you paid, there is no floor. It's taxes you paid to the state and local government, state income tax that you paid. It doesn't include taxes you paid to the federal government. It's income tax that you paid to state and local government. There is no floor. There's no 10% of AGI. There's no 2% of AGI. So it's just 9,000. So on line 5, we put $9,000. You see that? On line 5, put $9,000 there. Then, remember I told you that you're going to get from your mortgage company Form 1098. What does Form 1098 show you? It's going to show you the interest that you paid to the mortgage company, the real estate taxes that you paid. The reason why we care about this is because the mortgage interest and the property tax that we paid is going to be deductible on Schedule A. All right, so let's see what we found out here. So, continuing with our scenario, we're looking at taxes you paid. We said that they paid $9,000 in state and local income tax. We're going to put that on line 9. Then we look at real estate tax. So we look at the 1098. We look at 1098 and we see that in box 4, real estate taxes paid is how much?
7,950.
Yeah, 7,950. So we put that on line 6. So on line 6, we put 7,950. That's the information we're getting from Form 1098 for real estate taxes paid. We don't have any personal property tax. We put 0 on line 7. And on line 8, other taxes, we also put 0. Line 9 is the sum of the 9,000 and the 7,950, which is how much?
16,950.
16,950. Questions? So those are taxes you paid, 16,950. taxes you paid. The next section is interest you paid. So on our Form 1098 that I gave you, it says that the mortgage interest, the interest that we paid on our mortgage is $17,200. And the reason why we're interested in particular is because that's something that we could deduct on Schedule A on line 10. It's not subject to a floor. We could deduct the $17,200. This is for our residence, where we live. We talked about Schedule E, the rental property. The mortgage interest that we pay on the rental property is recorded on Schedule E. This is for the property where we live, the home where we live. So we occupy this entire home. Remember, we said our client also owns another home that they rent. The mortgage interest for that property is also deductible, but it doesn't appear on Schedule A. It appears on Schedule E. Remember?
Yeah, yeah.
So line 11 for our scenario is going to be 0. Line 12 is 0. Line 13 is 0. Line 14 is 0. But line 15 is going to be 17,200. Questions?
If you have like a summer house or something like that, you would be able just to include it all as one since it is.
Yes, you could deduct the interest for that as well.
And the real estate tax as well, right?
Yep. Gifts to charity. So our clients make some charitable contributions. Let's list those contributions and then see which ones qualify. So our clients gave $500 to a homeless family. Made a political contribution of $7,500. And
Policy for the what? Political contribution.
so there's a number of issues that we need to consider here. One of them is whether or not the contribution is made to a qualifying charitable organization. That's one issue. And then we also need to think about whether or not the amount of their donations is going to be subject to any limitation. So is 50% of AGI going to be a relevant limitation here? So what is 50% of AGI in this case? 60,000. So even if all of these were qualifying charitable contributions, they didn't hit 60,000 yet. Okay, so remember that charitable contributions are limited to 50% of AGI. Now, they gave $500 cash to a homeless family, which is a very noble thing to do. They don't have a check, but that's not really their problem, as much as it's not a qualifying charitable organization. So certainly it would be better if they had a check, but it's not a qualifying charitable organization. Now they gave $7,500 to a political campaign. $7,500.
Yep. That's qualified.
That's not qualified. No, it's not qualified.
No. So political contributions are not considered to be charitable. All right, per publication 529, if you want to check that. No.
So they can't deduct it somewhere, maybe?
Well, maybe it's miscellaneous.
Oh, because I'm sure so they donate a lot of money, that's like lobbyists, like it.
But it's not charity, though.
Oh, gotcha.
Now, they donated $15,000 to the mosque at which they were a member. It could be a mosque, it could be a church, it could be a synagogue, it could be a temple. It's a religious organization.
It can be qualifying like they have a 503.
Exactly. So they're a qualifying charitable organization, which in this case has religious affiliation. So the 15,000 is yes, right?
Yes.
So look at gifts to charity. So line 16, we're going to put $15,000. In line 17, we're going to put 0. Line 18, we're going to put 0. And line 19,
15,000.
questions? We good? All right, let's keep rolling. So, I told you that our clients have an AGI of $120,000. What I didn't tell you was that our client is a chef. Our client works in a restaurant, and our client has competed on Chopped and Guys Grocery Games, and our client decides that he wants to take cooking classes with Guy Fieri. So the cooking classes are $12,500. So the cooking classes are $12,500 with Guy Fieri. He has his own cooking shows, and he owns restaurants. He's a master chef. He hosts diners, drive-ins, and dives. Yeah, you should watch that sometime. He goes to all these restaurants, goes into the kitchen with them when they prepare the food, and he tastes everything. He's the food taster. So the cooking classes are $12,500, and our client also subscribes to a variety of cooking and food magazines. That's $500 a year. So in 2014, our client paid $500 for magazines about food and cooking, and paid $12,500 for cooking classes with Guy Fieri. What's important about those facts?
It's occupation.
So it's related to our client's occupation. Our client is a chef, so these expenses are related to their occupation. If they paid $500 for car service from the house to the restaurant, no. Everybody has to get to work. But these are expenses that they paid, that the client paid to enhance their ability, his ability as a chef. So the food and cooking magazines are $500. the cooking classes are $12,500. That's how much together? $13,000. How much of that do you think we're going to be able to deduct? So on line 21, we'll put $13,000. On line 25, we're going to put how much? What are we going to put on line 25? $120,000. And so the floor here is 2%. 2% of AGI is $2,400. And so when you subtract the $2,400 from $13,000, that gives us how much? $10,600. No, they didn't. They don't have proof of payment for that.
Professor, I'm sorry, where is line 25?
So with
It's
120,000, that's the AGI. So on line 25, we put 120,000 because that's the AGI. And the floor is 2% of AGI. So 2% of 120,000 is 2,400. So we subtract that from the 13,000 that she paid. For unreimbursed job expenses. That's going to enhance his career. Right, 10,600. Now, our client had an accident. So let's talk about property and casualty losses. Our client had a car accident. They paid $8,500 to fix the car. Interestingly, they bought the car 5 years ago for $4,500. The insurance company reimbursed them $2,500. So, what is the amount that qualifies as a casualty loss?
$6,000.
How did you get 6,000?
All right, no. 8,500.
So 8,500 is what they paid to fix it, and 2,500 is what they got back from the insurance company, and that leaves us with 6,000, right? Wrong! Wrong!
Exactly, Captain. Appreciate you.
So we have to take the lesser of the cost basis. So the cost basis is $4,500. That's what I told you. They bought the car $4,500.
Yeah, 4,500.
They bought the car for $4,500. They paid $8,500 to fix it. Why? I'm not really sure they could do that, but they did. And their insurance company gave them back $2,500. So we have to take the lesser of the cost to repair the vehicle and what they paid for it, which we refer to as a cost basis. So the cost basis, they bought the car for $4,500. From that, we subtract the $2,500, and we find that the qualifying amount is $2,000. How much of that are they going to actually be able to deduct?
2,000.
How many of you say 2,000? Nobody wants to raise their hand? How many of you say something other than 2,000? How many of you think that it's nighttime now? Raise your hand. Nobody raises their hand. So for property and casualty, for casualty and theft losses, the floor is 10% of AGI. So how much is 10% of AGI? 12,000. And how much is their qualifying out-of-pocket expense? 2,000. So they can't take a deduction for their loss. So on line 20, we put 0. So their total itemized deductions,
Do we need to put that 7,500 to the other, it says deductions, the policy code contribution?
no, not on Schedule A. No, political contributions are not deductible on Schedule A. So total itemized deductions is how much? Is that you, Venetia? 60,550?
Oh,
Opal! Opal! Hey, Opal. Tara. 60,550. That's their total itemized deductions, and since their AGI in 2014 was less than 152,525, there's no limit. There's no limit on their deduction. So if you have AGI that's over 152,525, your deduction is going to be limited. We'd have to compute that on a worksheet. But in our case, our AGI is 120,000, so our deduction is not limited. We could deduct the full 60,550 that we calculated.
So is it gonna be like him tonight?
On line 29, yes. So we talked about, what we've been talking about is deductions from AGI. So we've been talking about deductions from AGI, which is study unit 12, or in some, depending on the edition, it might be study unit 5. But what we talked about is deductions from AGI. We looked at medical and dental expenses. So you should expect to see a scenario like that, involving medical and dental, like the way we did it here. And we looked at a scenario that involved charitable contributions. And we looked at an example that involved a casualty loss. And we looked at a scenario that involved taxes paid. We looked at a scenario that involved interest paid. Each one of those scenarios, we said that they're interrelated and that they have the same AGI, but those scenarios, those are things that you need to be familiar with, like the way we did it here today. And then, what I think is really compelling is then we took all of those scenarios and tied them all together, and we're able to complete Schedule A. But that's the way you could expect to see the scenario when you're preparing a return. You got to gather all those bits of information and then evaluate it and determine what's relevant, what's not relevant, apply the tax code, and complete the schedules and forms. So we completed Schedule A, we completed Schedule E, we completed Schedule B. All right, so let's keep going.